Yes, ma'am, you can.
Okay.
Good evening. I would like to welcome our today's resource person, faculty of various participating colleges from Goa and across the countries, research scholars, investors, and dear students. The Department of Economics of Rosary College of Commerce and Arts is organizing a national level webinar on investments and investor protection by SEBI. SEBI is essentially a statutory body of resource persons of faculty of various participating colleges from Goa and across the countries, research scholars, investors, and dear students. The Department of Economics of Rosary College of Commerce and Arts is organizing a national level. Sorry for the disturbance. Yeah. The Department of Economics of Rosary College of Commerce and Arts is organizing a national webinar on investments and investor protection by SEBI. SEBI, Securities Exchange Board of India, is essentially a statutory body of the Indian government that was established in 1992. It was introduced to promote transparency in the Indian investment market. It is entrusted with the task to regulate the functioning of Indian capital market. The regulatory body lays focus on monitoring and regulating the securities market to safeguard the interest of the investors, and it aims to inculcate a safe investment environment by implementing several rules and regulations as well as by formulating investment-related guidelines. Now, I request Ma'am Sonia Vaz, in charge of Department of Economics of Rosary College of Commerce and Arts, to introduce our resource person for the day. Ma'am Sonia.
Yeah, good afternoon. Today we have with us Ms. Treasa Kuriala, Assistant General Manager of the Securities and Exchange Board of India, that is SEBI. Ms. Treasa joined SEBI Mumbai office in the year 2008. She worked in the Integrated Surveillance Department for 4 years and also worked in the Policy Department of SEBI, Market Regulation Department for 2 years. Subsequently, she was posted to Delhi office of SEBI and worked in Collective Investment Division and Inspection Division for 3 years. She joined SEBI Goa office in April 2017. I welcome Ms. Treasa, the resource person for today's webinar.
Thank you, Ma'am Sonia. Participants, please note the feedback link will be posted in the chat box at the end of the webinar. Now, I would like to request Ma'am Treasa to take over the session.
Thank you, Ivy. Thank you all for participating and being a part of this session. I presume I am addressing largely students of economics and commerce background. Through this session, we intend to create awareness about SEBI, role of SEBI, securities market. We wish to highlight the importance of saving and investments. We would like to introduce certain concepts pertaining to stock market or share market, securities market. And if time permits, we will also talk about mutual funds. I'm sure all of you have heard about RBI and are very aware about what RBI does. RBI is a regulator and it regulates banks and non-banking financial companies. The SEBI is also a regulator. We regulate trading in the stock market of listed companies. We also regulate intermediaries and entities who are actively participating in the securities market. An intermediary could be a broker, a merchant banker, a financial advisor. And we also regulate mutual funds. Mutual funds come under the purview of SEBI. I have a presentation with me. I'll start with the presentation. Like I said, there are various regulators, and we have SEBI, Securities, which regulates the securities market. We have listed companies under the purview of SEBI. We have intermediaries that are registered with SEBI that come under our purview. And any person who's involved in trading in the securities market would also come under our purview if there is any fraudulent practice being done. We are a very young organization. We were formed as an administrative body in 1988, and we come under the Ministry of Finance. There are three mandates that are very important to SEBI. One is investor protection. An investor would mean somebody like you and me who is buying or selling or trading in the stock market. And the other two mandates are the regulation and the development of securities market. So ideally, I should be now going ahead with explaining what a stock market is. But my question is, why are you all attending this webinar today? Being students, how is stock market or how is securities market important to you? Why should you listen to this? How will it impact you? And being economic students, being a webinar, usually it's a classroom session, so we usually interact and then conduct this session. I would like to start with the topic of inflation. Being economics and BCom students, you would know that inflation is basically, in simple definition, decrease in value of your money. Or it could be an increase in the average price of all products in the economy. If you were able to buy something for 100 rupees a year back, now you would probably have to shell out 110 to buy that same product. So you would have to ensure that in that 1 year's period, your money of 100 increases in value to 110. And hence you need to save and invest. Is saving and investment the same thing? Both are strategies that help you accumulate money. So what is the difference? Saving is definitely a safer approach than investing. However, investing in avenues can give you higher returns. Savings might give you a very safe avenue with your principal being safe, wherein investing, you might have the risk of loss of capital. But because of inflation, you need to not just save, but you need to invest. There are various ways of investing. And there are various ways of saving. You can keep money in your cupboard at home, that is saving. You can keep money in your savings bank account. You can keep money in a fixed deposit. You can keep money by buying gold, or you can buy and invest in real estate, or you can buy a mutual fund. You can invest in stock market. And hence we talk about stock market and mutual funds today because it is one avenue of investing, of ensuring that your money earns returns to you. How do you choose any asset or any investment avenue? Like I said, gold is an asset. Putting money in real estate is an investment opportunity, or buying a mutual fund, or investing in the stock or share market. So these are different investment opportunities. But for choosing any investment opportunity, you must consider three main things. One is return, safety, liquidity, in any order that you would like to consider. Keeping money in your cupboard is probably safe and it is liquid. Or keeping money in savings bank account is safe and you might get nominal return. And it is of course liquid. Similarly, keeping money in FD. But will keeping money in savings bank account give you enough returns to beat inflation? Will your 100 rupees in your savings bank account ensure that you are able to buy something after 1 year for 110? Hence, we say that investments in mutual funds and securities or share market is important as an asset class, to ensure that you earn greater returns. Of course, there is risk involved. So where do you put your money in? Only in gold? Only in equity or shares? Or only in savings bank account? Or is it only in fixed deposits? So you need to do a diversification. You need to diversify such that you have your investments in various asset classes so that a risk in a particular asset class will ensure that your other asset classes give you enough returns. Even in mutual funds, there is many opportunity to diversify. Similarly, in buying shares, you needn't buy just one single share. You can diversify across categories, across blue chip, mid cap, small cap. There are many various categories of stocks. And you needn't just put money in the securities or share market. You can put it in savings, post office, PPF, pension. There's a lot of other asset classes. But it is important to diversify so that particular risk is across and you do not, the asset value does not get impacted. Like I said earlier, these are short-term investments, savings bank, post office, and medium term would be bonds, mutual funds. Investments in shares and mutual funds, we would suggest going for a long term of 5 or more number of years. And again, the risk is highlighted. Investments in equity shares, mutual funds are highlighted in orange, meaning there is medium risk involved. Wherein if it is a bank deposit or if it's a post office or a public provident fund, the risk involved is very low, hence it is highlighted in green. And something which is really risky is probably investments in derivatives, which is again something pertaining to a share market. So why do we ask you to have an idea about securities market? Because by investing in securities market, you can diversify. You can ensure that your capital is also growing along with returns. And there are also tax benefits for your investments. Usually, this is how people save. You earn after your expenditure, whatever you save is what you have to invest. However, people who've started working and who've started earning for the past many years realize that at the end of the day or at the end of the month, there's nothing to save because after all the expenditure, your income is less and probably you've already borrowed money. Hence, we feel that this formula is wrong. And as students, we feel that you must realize that your savings need to be first priority. Decide on how much you will save. After you start earning, at the end of the month or beginning of the month, you decide how much you will put aside as saving. And the rest of the money should be your expenditure. Only then you would be able to start and slowly and steadily increase your savings and thereby also have investments. We've started giving these presentations to college students mainly because we feel that as youngsters, you have many years ahead of you. And once you start earning, you must start saving immediately. The reason being is the power of compounding. This is a particular table where you would see that somebody who's invested from the age of 21 regularly for 12% compound rate of return will have something which is 1 crore 17 lakhs. And this is no calculation mistake here. This is true. If somebody is going to invest 1,000 rupees per month from the age of 21, and somebody who is going to invest only at the age of 31, the amount that he is going to have at the age of 60 is greatly different. One is 1 crore 17 lakhs and one is 35 lakhs. only because the person Shyam did not start investing from the age of 21 or from at the earliest age possible. You might think it is just 1,000 rupees per month and for a period of 10 years, that is 1,20,000, which Shyam has not invested. But no, it is the power of compounding which has helped Ram increase his wealth. Now, I'm not saying you're going to get every year 12% per annum, but whatever be the rate of return that you are investing in, it is important that you steadily keep investing any amount, but you keep going. And as your income increases, you increase the amount of investment. So from 1,000, you can keep increasing as your income. So we urge students to keep these in mind. Today, you might attend this session, but after 3 years, after you finish your post-graduation, you might start working. We kindly ask you to keep these things in mind so that it would be of help to you once you start working. Some of you may not be very keen on investing or using their own information and knowledge to choose companies, to choose mutual funds, etc. You might require a financial advisor. In such cases, kindly only deal with SEBI registered intermediaries, see their track record, see their qualifications. There are a lot of intermediaries who would provide you service. So see what their fees are, what is the track record, and only then go for a financial advisor. And if you're confident of investing on your own, well and good, go ahead. There is this misunderstanding that investment in stock market is like gambling. We wish to disagree to this fact. It is your informed decision to put money in an asset, which is again, whether it is mutual fund or whether it is a share that you are a company's share that you are buying, it is an informed decision. You are investing in the underlying business of that company. And if you think that the company is going to progress, your money in turn will increase and will grow in value. So you need to put your effort for your money to work for you. So like I said earlier, choose investments wisely. Even if you're dealing with financial advisors, choose them wisely. Know whom you're dealing with. If you need help, know where to go for help. You must read articles. You must search for websites which will help you with knowledge so that you have an informed decision. Now we will learn about securities market. Securities market is also called share market, share bazaar. It is basically where the shares of listed companies are traded. Earlier, they used to be present. I mean, we used to go to the stock exchanges to bid and to buy and sell the shares. Now it is a virtual marketplace where everything is done through internet or on your phone. And with security is the same as share of a company, but the securities are bought and sold. Like I said earlier, there are intermediaries who are active in the securities market. There are companies, there are stock exchanges, brokers, merchant bankers, clearing corporations, depositories. Now, the shares of companies are traded on the stock exchanges. The stock exchange is just giving you a platform, giving the companies platform for their shares to be listed and traded. If you need to trade or buy or sell a share, you need to approach a stockbroker. He will open an account for you, and through that account, you can buy and sell shares. If you have bought a share today, you will get a share certificate. Earlier, it used to be a physical share certificate. Now it is just a credit in your account. And what account is that? That is called a demat account. A demat account is opened with the depositories. A DP participant, a depository participant will open a demat account with you for you. And if you buy a share, any share, there will be a credit in your demat account. If you buy one share of X company, there would be one share credited in your demat account. And if you sell that share through the broker, the demat account will be debited and you get your money. The clearing corporation does all the risk management. asset management companies and merchant bankers are intermediaries to do with mutual funds. Merchant bankers help companies list their shares on the stock exchanges. But basically, as a retail investor, you should know about a broker, because you need to open an account with a broker and a depository DP participant to open a demat account. For trading, you need 3 accounts: a bank account, a broking account, and a demat account. These days, a lot of them give you, if you approach any of the broker, he would have all the 3. He would be, I mean, if you approach any of the big companies, if it's an HDFC bank, they would have a broking account, a demat account, and a bank account open for you. Similarly, Axis or all the big players have all the 3. But you would need to also look at the prices or the commission or the fees charged by them, so that you can accordingly decide which broker you would like to approach. What is a share or a stock? If let's take ABC company, they are doing business. There are 2 friends which are doing business, and the company's name is ABC. Now they've put their own money and they've done, it's a partnership firm. Now they realize that they need more money. They approach 10 more people, and the 10 people say they are willing to invest in this ABC company. So ABC company will issue share to all 10 of them, and these 10 people will give money to ABC for that share that they are receiving. So one share is given to each person, say, and for 1 share, 1 rupee say collected. So 10 rupees would go to ABC. Now ABC is doing business. ABC realizes it needs more money. So ABC realizes it needs to approach more people, not just 10 people. They need to approach maybe more than 50 people. So then they need to come to SEBI to get permission. They need to come to SEBI to get permission to list the share that they will issue to public. Many people would be public here, you and me or any other person here sitting here. So to approach the public, they need SEBI's permission. They can list these shares on the stock exchanges. So this practice of companies approaching SEBI to list their shares for the first time, it is called an IPO, initial public offering. They're coming to the public for the first time. And why are they coming to us? So that they will issue shares to us and they will take money from us. So for 1 share of ABC company, we will probably have to say give 500. That is the value of ABC. Now the shares are listed on the stock exchange. From the time it is listed onwards, it is traded in the stock exchange. Then it is called the secondary market. So the first time when the company is coming with an IPO, it is called a primary market. There is no listing or trading. You buy the shares directly from the company through a process called ASPA. So you get the shares in your demat account and your bank account is debited. Your demat account is credited with the shares of the company through IPO. The shares will be listed, say, at 500 rupees. It is decided by the company, and the merchant banker helps the company decide on the value of the price of the share, which says 500. It gets listed. From there, it is trading in the secondary market, and trading happens on the stock exchange. So here, like I said, this graph shows, see, it's a new business. They need more money. They come, they give the share certificate. Earlier, it was a physical certificate. Now, like I said, SEBI has brought in development. So now it is only a credit into your account. So there would be 1 share of ABC in your demat account if you have bought a share. It is going to the public. The public is giving money to the company. And mostly, why do they need money? Public, this is the company, and they come to say issue shares, and the IPO gets listed. And in your account, in your demat account, the shares will get credited, and your bank account, these shares will get debited. The demat account is with the depository. And once the IPO is over, it starts trading in the secondary market. IPO usually happens within 6 days. Now, how does the secondary market function? Like I said earlier, the shares are listed on the stock exchange. Now, say the shares started trading at 500. If there is more demand for the shares, the price will increase because more people want to buy. And if there is not much demand for the shares and people want to sell because they do not feel that this company is worth 500, people can sell their shares. And once many people start selling, the value of 500 will start coming down. So the trading in this secondary market is always a function of supply and demand. If there is more demand, the price tends to go up, and if there's not much demand for the stock, the price tends to come down. Now, if you read Economic Times or any such paper, you would see that there are articles which say Sensex is going up or Nifty is gone up. It's a bull market, it is a bear market. Now, these are terms which are pertaining to the securities market. Now, what is Sensex? Now, there are thousands of companies listed on these stock exchanges. We have two main stock exchanges called NSE and BSE, National Stock Exchange and Bombay Stock Exchange, and we have other stock exchanges as well. So there are a lot of companies listed on these stock exchanges. Now, how do we know that? How do we gauge whether the companies are in a up market or up movement trend or a down movement trend? So we have two indices called Sensex and Nifty. Sensex is of BSE and it is formed by 30 companies, top 30 companies. Similarly, Nifty belongs to NSE Stock Exchange, and Nifty is a combination or is a compilation of 50 top companies. So when they say Nifty is going up, it means that the share prices of majority of these 50 companies are going in an upward trend. And if they say Nifty is gone down, it means majority of these 50 companies, the shares are trading at a lower price. It would have started trading at 500 and if now it's at 430 or 440 rupees. So this is how the market is being understood by the people. That if Sensex is up, it means the share prices of majority of the companies are doing or going up. And if market is down or Nifty is down, the prices are going down. So a bear market is when prices of majority of companies are going down. So it is bearish. There is a bearish view. It could be because of any news in the media, any domestic news or any international news. Anything can impact prices of companies, and hence there could be a down movement and a bearish movement. Similarly, when the market is bullish, it means prices of majority of the companies are going up. It could be again because of some new bill passed by the government or some new reforms brought in by the government. So a lot of factors can impact the securities market. When there was this pandemic going on, the market had crashed, as in there was this downward movement. And then probably when there's the news of a vaccine, probably it can impact the prices. So a lot of news, news and other factors impact the movement of the securities market. And when I say movement, it means the movement of the individual stocks in the which is trading on the stock exchanges. When you trade in the market, so you have, say, opened an account with a broker and you have put in an order to buy the shares of ABC company. So when you have put in an order today, from your bank account, money will be debited and your shares will be credited within 2 days. So if T stands for the trade day, you have put in a trade today to buy. Within T+2, within 2 days, these shares will come in your demat account. And within the next, immediately or the T+1 day, the money will be debited from your bank account. So T+2 is the settlement cycle for trading in India. So if you're trading on Monday, the settlement will happen on Wednesday. If you're trading on Tuesday, the settlement will happen on Thursday. So it is a T+2 settlement. This was explained earlier, a primary market and a secondary market. Primary market is when you buy it from the company directly when they approach us with the initial public offering. And then once the shares get listed, you open the account with the broker and you buy the shares which are trading on the stock exchanges. When you're opening an account with a broker, you would require basic documents such as your PAN card and bank account, Aadhaar. And you also need to have account. Both are necessary when you're trading. Then account, it is the same documents which you require. When you go to open an account, you will be given documents to fill and sign. Some of the documents are mandatory, like your PAN and Aadhaar, and certain documents are not mandatory. For example, there is this power of attorney option. It is not a mandatory document. If you do not wish to give power of attorney to your broker, you don't have to. Even in spite of it, an account should be opened. Nobody can force you to sign the power of attorney. The reason why we've highlighted this power of attorney option in red is that at times, one account opening form. And like I said, there is this option which is if you don't want to give power of attorney, you don't need to. Any dispute that you have with your broker, you are requested to file a complaint within 7 working days. In fact, when you trade today, at the end of the day, you will be given an SMS saying this is the trading done by you. So many shares have been bought or so many shares have been sold, and this is the statement in your Demat account, and this much money has been debited. All of you, when you start trading, you are requested to go through the documents that are being given, whether it is end of the day or whether it is at the end of the month. You need to be aware of what is happening with your Demat account and with your money which is lying with the broker. Any discrepancy that you see, you needn't wait for 7 working days. You need to inform the broker immediately. And if you feel that the broker is not resolving your complaint, only then it needs to be brought to the notice of SEBI. And if you have bought or sold shares, the settlement, like I said earlier, it has to happen within T+2, which is 48 hours. So you need to keep a track of what is being done in your account. Details of trading that is done by you daily comes through your email as well. So you give a valid email ID. Ensure that whenever you change your email ID, your phone number, you inform your broker as well, so that they are able to sell or send across these details to your current mobile number and email ID. Like I said, power of attorney, since the power of attorney can be misused, you need not give or sign the power of attorney. It is not mandatory. And the power of attorney should be used only for meeting settlement obligations by the broker. You can make account paying. Nowadays, a lot of people do trading through internet or using the app on the phone. So it becomes very convenient. So usually it's through internet banking that money gets debited. But there are other modes like demand draft and account paying checks, etc. Like I mentioned earlier, you need to be receiving your SMSs and email alerts on trade. So regularly update your mobile number, and you receive all the documents that you need to receive once you sign an agreement, so that you are safe and you would know what you have entered, what agreement you have entered into with your broker. Don't trust any hot investment tips or tips providing unrealistic returns on investments. Be clear about the brokerage, the fees, commission. Obtain a copy of all documents executed by you from your broker. Don't make any payment in cash. Take documentary proof of your payment or deposit. Don't share your internet trading account password with anyone. We get a lot of complaints from people saying that since the financial advisor asked me, I gave him the user ID and password and he was trading on my behalf, and now he has made a loss in my account. Once a loss is made, it is really difficult even if you complain to SEBI, because you voluntarily gave your user ID and password. I'm sure as students you would be more aware of these things and you would probably will not share. But again, it is being reiterated that don't share important information with anybody. Bring any dispute to the notice of the broker within 7 working days. And if the problem is not resolved by a broker or by a DP, then you can come to SEBI. And there are a lot of financial advisors who are not registered with SEBI. So if you're taking the help of a broker or a financial advisor who claims to be SEBI registered, you please log on to SEBI website. There is a list of all intermediaries who are registered with SEBI. The names are given, the numbers are, registration numbers are given. Kindly check if it is the same entity and only then deal with SEBI registered intermediaries. Visit the website of SEBI or stock exchanges for updating your knowledge of trading activities. If you go onto the BSE or NSE website or a lot of other websites, where you will get details of all the scripts that are traded on the stock market, their balance sheets, their the price at which they are trading, the history of, the past data of the trading, etc. So if you would like to know more about any particular company or any script, there's enough and more information that you can access from these websites. I would now what is the importance of mutual funds? I think you would have heard a lot of advertisements also on mutual funds. Before I move on to mutual funds, I wanted to mention that when I mentioned about savings and investments, some of you probably must be in the final year, you might want to work after your graduation, or you might want to be a post-graduation. Any which ways, it is a time when you can also discuss with your parents as to how investments and savings are being done, so that you would get a practical knowledge. You would probably like to know how they are investing. Are they taking the help of an advisor, or are they investing directly in the market, share market, or have they diversified? So since you are right now in college, you must be aware, and it is a good time to know how money is being, or accounts is being managed by your parents, and it is good to get into a good discussion on getting knowledge as to how your parents are doing their investments, so that you would also have an idea. Now, what is the need for mutual funds when you can invest directly in the stock market or share market? Now, like I said earlier, there are a lot of companies which are listed on the stock exchanges, thousands of companies. Now, how do you choose which company to invest in? Unless you have a lot of time and you are a full-time trader. Traders are people whose job is full-time to sit in front of the system and buy and sell, keep buying and selling. So they would be aware of which company is going to go up, or which company might be giving a return in the long run or in the next 1 hour. But we who do not have time to decide on which company to choose, or we do not have enough knowledge to choose the company or go through the balance sheet and understand the value of a company. And for such people, and if you need to invest your money, mutual funds is one such option. Like I said earlier, it comes under the purview of SEBI. These are managed by professionals. So these professionals are knowledgeable, and their job is to manage your fund. So if you want to invest in a particular company, some of these companies are very, very highly priced. It could be 60,000, 20,000, and you might not be able to even buy one share of that company, but you want to be a part of that company. When you buy a share, I forgot to mention this, when you buy a share of a company, you are becoming a shareholder of that company. You are being a part of that company. So if that company does well, and if company announces dividends, etc., you being a shareholder will be able to partake of that. So if you feel that XYZ company is doing very well and you want to be a shareholder, or you want to be a part of that company, but the price is say 25,000, you may not be able to buy the price or buy the share of that company. Forget 100 shares, you won't be able to buy one share of that company. Even that way, if you are buying a mutual fund, what a mutual fund does is it pools money of all such investors, not just you. You might have 500 rupees to invest this month. There would be somebody else who might be investing 1,000 rupees. Another person might be putting 10,000 rupees. So all this money would probably be invested by that fund manager. A fund manager is asked to manage your funds. So all this money is being pooled, and the fund manager's objective is to earn good returns on the money that is being invested. So now it is up to him. So the fund is being managed, and the objective is probably to buy only Nifty stocks, all 50 stocks of Nifty, or to buy only blue chip companies. Now, what is a blue chip company? Blue chip companies are companies that are large corporations that are doing extremely well. They are the biggest ones and performing really well based on market capitalization. So maybe objective of the manager is only to buy blue chip companies, or the objective of the fund manager is to buy only into growth companies, companies which are right now small but might have a great future. So those are growth companies, or small cap, which have small capitalization, which are yet to grow, or might in the long term of 5 to 10 years might give you good return. So there are many objectives. So for a common objective, you can choose. You can choose whether you want to invest in a blue chip mutual fund or whether in a debt mutual funds. Debt mutual funds are funds which will mutual funds which will only put your money in debt funds or debt corporate bonds. So mutual funds, in this case, you don't have to worry as to which company, which fund, which bond you have to choose. It is managed by the fund manager. And why? Because it is convenient. You don't have to go through many shares and see which share to buy. You can just decide on the mutual fund that you would like to. There is liquidity. You can sell anytime the units. Of course, even shares you can sell anytime. It is highly liquid. This is being managed by a professional management. So if you do not have the time to invest in stock market directly, you can put money in mutual funds. Diversification. The fund manager will not just be buying the shares of one single company. He can use all of this money and he can probably buy 50 shares or he can buy 30 shares. So in that way, there's a lot of diversification, because even if one sector, say the banking sector, is not doing well, your money is not only in banking sector, it could be in other pharma sector or FMCG. So your money is your fund would be well diversified. And if you're investing directly through the internet in mutual funds, the cost is also less. There are various mutual funds, and if you say, example, if you go and choose a mutual fund, it will give you the riskometer. The riskometer is mandated by SEBI. It will show you how much risk is involved in the mutual fund. So I'm not saying that mutual fund is a risk-free investment. No. You're not sure whether the fund manager is going to perform well. We don't know. But it is less riskier when compared to probably directly investing in share market if you do not have the knowledge and the capability to do so. So the mutual fund has to label itself, whether it is at low risk, moderate, high, moderately high. So depending on the riskometer, you can also decide whether you need to go for which mutual funds. There are mutual funds which invest only in equity. There are mutual funds which invest in a combination of equity, debt. There are a lot of other mutual funds which focus only for retirement. Mutual funds which only give you for a particular goal you have, which is like a solution oriented for your child's education. This is a solution oriented scheme. So there are a lot of mutual funds. Now, these are important points to remember, even in whether it is through mutual funds that you're investing or whether it is in the stock market or whether it is any other investment. Start small and keep a track. Be consistent in your investments. And once you're confident, you may decide to add more money. And stay diversified, whether it is buying shares or whether it is putting money in mutual funds or whether it is in a bank deposit. You ensure that you don't put all your money in one particular asset class. This is also very important. The more you trade, the more the broker earns. That is why we say that as retail investors, you and me would be considered as a retail investor. We need to buy shares that we wish to keep for a long term of say 3 years, 5 years or more. We should be confident of the stock that we are buying. We should not buy stocks that we buy today and sell tomorrow. It is the broker who's going to earn commission on each trade that you do. Each time you buy, each time you sell, you need to pay a fee to the broker. So as retail investors, your aim should be to buy shares which you can keep for a longer term and ensure that you keep a track of the company that you're buying, read the news related to such company, see whether they're doing consistently well, and continue to own the stock. Do not blindly follow market tips or rumors. There are a lot of people who would probably let you know that there is some news coming up about ABC. It is best to sell the ABC stock. Do not blindly believe them. You might sell and the next day the price might go up. So you might have sold at a loss. So do not follow market tips or rumors. And when you are getting into an agreement with any document, signing any document with any intermediary, ensure that you strike off all the blank fields and you keep a copy or ask for a copy of the document that you are signing in. Again, since there are many asset classes, if you keep your money in your savings bank account, probably today you might get 3 to 4%. And if you're putting your money in a fixed deposit, you might get a 6 to 7 or maybe 8%. And we believe that if you invest in the stock market or through mutual funds, you have a chance of earning a higher return consistently over a longer period. But there are people who would come to you and who might tell you that they can earn for you 20 to 30% or 50% or double your returns. We get a lot of complaints wherein people have given money for whatever reasons because the other person assured them that they would double their money. You give me 10,000 today, I will give you 20,000 immediately or within. So you need to realize that nobody can give you so much or unrealistic returns. So do not give money to anybody. There were a lot of scams earlier. There are a lot of frauds happening even now where people, gullible investors are falling for such schemes. So when you're dealing, only deal with registered intermediaries. Only deal when you are sure that you are okay with, if at all you are putting money, you're okay with losing money. You should only invest that money if you're okay with realizing a loss on that amount. SEBI has started a grievance redressal mechanism called SCORES. It is complaint redress system. It is an online portal called scores.gov.in. Any complaint that you have against any SEBI registered intermediary, firstly, we would ask you to approach the intermediary first and then try to get the complaint resolved. If not, you can approach the stock exchanges, NSE, BSE, or the exchange where you are trading, and you can ask them. And if you feel that your complaint has not been redressed as per your satisfaction, then you can approach SEBI. You are requested to lodge the complaint through the online mechanism by uploading the details through scores.gov.in. So you will be able to know with whom your complaint is pending, and you will also get the resolution through the online mechanism. Happy investing, and this is here I come to the end of my presentation. Any questions that you have, we can answer.
I request the participants, if you all have any questions, you all can put up. Participants, you all can type in your questions in the chat box. Participants, please note the feedback form link is also posted in the chat box. Okay, ma'am, I have one question. Yes,
sure,
ma'am.
Yes.
Right now, it has been seen that there is 25% upfront margin requirement that has been made for the investors who want to invest.
Yes.
Like it will go on increasing like till the next year. So will it affect the investors' decision of investing?
The reason why margins are being actually imposed or brought in now is that the markets are highly volatile, and we do not wish that retail investors like you and me, who are probably not very aware, trade in the market, and hence to be on the safer side, these margins are imposed.
Yes, ma'am. Yes, ma'am.
We understand it could be, I mean, you would find it difficult, but it is only to safeguard the interest of retail investors.
Okay, ma'am. But what happens is that before, when an investor used to invest, he could invest without keeping the margin requirement. But now he has to keep a margin requirement.
Even earlier, there used to be a margin requirement. It's only that now the amount has been increased.
Okay. Okay.
competitive market. There are many brokers. There are people who even provide zero fee and only maybe fixed 20 rupees for every trade, or maybe it doesn't matter how many times you trade, his charge is only 20 rupees. Or so there are many brokers. So it is up to you to decide which broker you would like to choose, depending upon the cost, not just the charges, depending upon the track record of the broker, whether there are complaints against the broker, what is reputation. So there are a lot of choice, things that you need to look into while choosing a broker. How is his service? So don't go just by the cost. Of course, there are a lot of low-cost broking platforms. But yes, a broker charges commission. What is Bitcoin investment? Bitcoin is something like a cryptocurrency. Now, it has got a little bit of history in it. It's just that it is not. Now, if it is Indian rupee is being vouchsafed by our Indian government, saying that there is the governor's signature on our Indian rupee. Similarly, if it is dollar, it is the US government which is vouchsafing the dollar. Wherein Bitcoin is not controlled by any government or any monetary organization. It was started by a person. I don't remember the name of the person, but he started.
Is it Satoshi Nakamoto?
Yes. Yes. You're well aware. So he started it, and what happens is that if you nowadays there is no ban on Bitcoin. You can I think it is started with a low value. Now it is really high. Problem with Bitcoin is that the prices tend to fluctuate a lot. So you need to be able to accept that risk. Now there could be a future wherein Bitcoins would be accepted as normal currency. We do not know how it is going to go about in the future. Now it is not easy to use Bitcoin to buy and sell any product. Like the very platforms that will probably enable you to use Bitcoin as a currency. There are exchanges which will let you buy or sell. You have to sell a Bitcoin. What happens is say you want to sell a Bitcoin. There are miners who are sitting who should be able to do a mathematical programming. Once they do that mathematical programming, only then they will be able to know that you actually have those Bitcoins. Once they have successfully mined or done that mathematical programming, you will be able to sell those two Bitcoins. And once you sell, it will be a part of a blockchain. That's why it is called blockchain investing. Because any Bitcoin that is being sold will all be part of one chain. So the miners will have to do a bit of programming and it will take time. So it is not easy to use Bitcoin as a currency to just buy and sell, because if you want to sell, it takes at least 10 to 15 minutes or more for that miner to be able to ensure that you have and he is able to sell. And the miners will charge their commission. So there is no ban by any agency. It is probably risky. It is up to the individual person's nature, whether you want to invest in something which might have a future or which may not have a future and which is currently very volatile.
Ma'am, there's another question. Is it safe to invest now? Because the economy is not doing that good.
I cannot comment on that, whether it is safe to invest, but I would like to say that do not time the market. Today, you might, if you want to buy XYZ company or you want to buy XYZ mutual fund, you might be thinking 500 rupees is high. I will wait for the price to come down to 400 and then I will buy. Maybe after 1 month, the price has reached 700. So you have lost an opportunity to buy at 500. So you can never. And probably once you bought it at 500, maybe the next day it has come to 400. We don't know. We really don't know whether the market is at a high or whether it will go down tomorrow, whether it will go up. So if you are confident of which asset you want to invest in, you please go ahead and start. What happens is now we've been working for some time now. And we've realized that this waiting to decide whether I should invest or not, it is actually not good, because at the end of the period you realize you haven't invested at all. You have all along been waiting for the right time. So it is just best to go ahead if you are confident, if you've done your basic studying about the company or the mutual fund, you've done your analysis, go ahead and invest. but be sure that you should be able to take the risk. And most of the assets will have a lot of volatility. It will keep fluctuating. So if you are confident, you keep that asset for a minimum period of 3 to 5 years and keep a track of your investment. Don't just buy and forget about it. Think, I will buy for long term and then look at it after 5 to 6 years. No. When we say buy and keep it for long term, we also want you to keep a track of that investment. And if you feel after a year or two that the investment is just not doing good, then you should also have the risk appetite to sell the investment at a loss. A lot of people buy something and they are seeing it is going at a loss, it is going further losses. It's been 3 years, still going further loss, and they'll think, no, I will get it to come up. Finally, it will be a negative. I mean, it will be at a really large loss. You feel that you have got into something which is not giving enough return or not, should also have the capability to be able to withstand that loss and sell that. What happens in market crash and what are its effects on the stock market? When we say there's a negative news which is coming in the news and the media, people are probably reacting adversely to that news, and people who feel that it's a negative news and they want to sell. So when there's a lot of selling in the market, that is when the market crashes because the prices are going down. There's a lot of supply of shares and there's not much demand. The effect is that the prices of a lot of companies come down. But you must also realize that these ups and downs in the market are very, it keeps happening. So in the long run, if you see Nifty or if you see Sensex, it has an upward movement. There are always these periods when the market falls, and it will take some time probably for it to come out. So I'm not sure the effects on the stock market. When there is a market crash, the majority of the prices come down. Nothing more than, and when there is a good news, the markets go up. It is mostly the mentality of people trading in the market. The supply and demand. Those who want and those who will buy and those who don't want, they will sell. So the price and demand and supply.
Participants, any more questions?
I just want you to see, not all would have understood, though it was a very basic presentation, but the idea is that to keep some of these terms in mind, start reading books. If you are interested in this field, start reading books, start reading Economic Times or any such paper. There are a lot of books. There's Benjamin Franklin, and there are a lot of books that you can probably read to get an idea of how stock market works and how investing should be done on mutual funds. It's not books. There are a lot of these online websites which also give you information. So keep reading and increase your awareness so that maybe later on you might find all this useful once you start working and once you need to do investments and savings. Right now probably you're studying and you need it only for your exam or for your subject. Once you start working and you need to apply it to your real life situation, you should be able to, you should be prepared for it.
Yes. I think we are done with the question and answer sessions, ma'am. Yes. Okay. It's my privilege to propose the vote of thanks. I, Ms. Ivy Simoes, Assistant Professor of Rosary College of Commerce and Arts, would like to propose the thanks. I would like to thank Ma'am Treasa for imparting us with information, for creating awareness about the various rules pertaining to investor protection, also making us aware about the instruments in the securities market. A thank you to the acting principal of Rosary College of Commerce and Arts, Associate Professor Helic Barreto, our administrator, Reverend Professor Simão Diniz, the teaching and non-teaching staff for their contribution towards this webinar. I hope our participants will make an informed decision about their investments. Thank you all the participants for participating in this webinar. Thank you.
Thank you, Ivy.
Participants kindly fill the feedback form